Good morning to all of you. It gives me great pleasure to be here at the second edition of the Financing Summit. And I must compliment the summit chairs, Secretary DFS, Chairman SBI, Chandradeep Banerjee, to have put together this platform that brings together and hopes to shape and bridge the gap between policy, innovation, and investment. It's indeed a unique platform, and I look forward to the deliberations that will go on for the next 2 days. As we gather here in Mumbai, the financial hub of India, we meet at a pivotal time. The Indian economy stands firm and stable. The recent uncertainties created by global tariffs have not impacted the economy severely, reflecting the resilience of the economy and our exporters. The financial sector, which was plagued by the twin balance sheet problem in the last decade, has moved in the last decade to becoming more strong, inclusive, innovative, and now is a catalyst and reflection of India's economic transformation. This has been made possible due to several measures targeted at recapitalization of public sector banks, strengthening NPA recovery mechanisms, and as Secy said, healthy resolution practices as well. In this, the IBC has played a strong role. The government's renewed emphasis on the ease of doing business and a healthy cooperation between the public and private sector has worked together to meet India's vast financing needs, whether it is for infrastructure, MSME credit, green transition, or social development. The Indian financial sector has grown to be one of the most stable amongst emerging economies. I was thinking about, and I was trying to jot down the reasons and the factors that have led to this. And I would like to dwell upon some of these things which have already happened, the steps which are ongoing and have been taken, before I come to some of the trends that we are seeing in the Indian financial sector, which we need to collectively examine and think about, because the landscape is changing and changing fast. So first, a reflection, being the starting of this summit, a reflection of what has held us in good stead so far, and what going forward needs to further be done. The first amongst this, I must say, is the prudent regulation and supervision of our financial sector regulators, who have strictly enforced disclosure norms, protection of investors, and improved governance. The next I would place on gradual and controlled liberalization, which has held us in good stead, avoiding shocks and sudden capital flows and abruptness. A strong banking system, as we all know, with public banks providing prudent stability and widespread reach, and private banks bringing in innovation and competition, which is not to say that public sector banks are not vitalizing their own growth and the economy's growth through innovation. Deepening of financial inclusion and expanding banking services via the Jan Dhan Yojana, the UPI payments, and a wide network of self-help groups and microfinance, all of it ensuring more people in the formal financial system, providing a broader, more stable deposit base. A calibrated approach to foreign currency exposure, which has helped us avoid serious currency mismatches. A strong payment and digital infrastructure, which has reduced transaction costs, improved transparency, and increased formal financial activity. Diversified financial architecture with many different types of financial institutions as we stand today, whether it be commercial banks, NBFCs, housing finance companies, insurance companies, pension funds, mutual funds, cooperative banks, all of which has led to a diversified system which has helped spread risk across different institutions. Focus on investor protection, some of the recent examples which have reiterated this being the deposit insurance law, regular stress testing of banks, prompt corrective action framework to identify weaknesses early for rectification, encouragement of transparency in corporate governance through adoption of global accounting system and mandatory disclosures. Here the role of professionals and professional institutes comes in very strongly, as the foundation of financial system rests on true and fair view not only of financial statements, but also of governance standards of corporate entities as well as their counterpart financial institutions. Lastly, might I say, fundamentally, the strong macroeconomic management of the economy on which all of this rests. Stable monetary policies, transparency in fiscal space and fiscal consolidation, controlled inflation, and more than adequate foreign exchange reserves. On top of it, I would reiterate the focus on government on continuous look at reforms and ease of doing business. While we reflect on all these things which are done and being done, we recognize that to meet our goal of a sustained 8% growth to GDP target, we need a lot of investment to flow in, and therefore the entire financial system, banking system as well as capital markets, assume a pivotal role in channeling savings towards investments in productive segments of the economy. I will go through some of the points that I have mentioned again to highlight the important pillars that we need to examine, and in the end, like I said, some emerging trends that we collectively I would like to place before this extremely brilliant and esteemed audience, so that the next 2 days we could all collectively think about those. We know that the COVID pandemic actually became a defining moment that catalyzed India's digital transformation, and the entire Jan Dhan, Aadhaar, mobile connectivity, how it was connected to UPI, creating the digital public infrastructure, which we all use, the potential it has to accelerate economic growth has to be now realized. For this, the government's push for digital infrastructure, central KYC registry, paperless trade networks, which is aimed at fostering a vibrant environment for fintech startups and established players both in the financial sector. Today, India hosts a number of fintech unicorns accounting for nearly 50% of the world's real-time digital transactions. Through the deployment of Aadhaar-driven DBTs, India has also achieved remarkable fiscal efficiency, eliminating leakages and ensuring that subsidies reach the genuine beneficiaries. We also have now started targeted schemes such as the Credit Guarantee Scheme for Micro and Small Enterprises, the Pradhan Mantri Mudra Yojana, and Stand Up India, which have democratized access to collateral-free credit, empowered women and marginalized entrepreneurs. At the same time, innovative credit delivery tools such as GST Sahay, built upon the Open Credit Enhancement Network and account aggregator frameworks, all of which the point that I'm making is the importance of the democratization of credit and formalization of the economy, which are both fundamental foundations for a strong financial architecture. The capital markets, including the growth of the IFSCA, and going forward, more work on this needs to be done. India's capital market growth has been strongly underpinned by sweeping forward-looking reforms introduced by the government through law as well as the market regulators, particularly SEBI and IFSCA, aimed at easing capital raising, deepening investor participation, and strengthening governance. As a result, market cap, which stood around 100 lakh crores in March 2015, has doubled every 5 years and reached close to 475 lakh crores as on 12th November this year. Going forward, however, there are 3 areas I would list down as areas which need further work, further attention, not only by government, but all of you all here in the room. Not new sectors, not new topics, but we need to focus attention and get something going on these. Firstly, the corporate bond market. Though larger than ever before, it remains dominated by highly rated financial issuers and has a weak secondary market liquidity. The government did come up with a new product, the Bharat Bond, the first corporate bond ETF, which led to the creation of a new asset class. That was an attempt when it launched bonds between 3 to 11 years to provide an instrument, a safe investment option, help to deepen the market, develop the market. However, more needs to be done on this. We need to do more on market making, credit enhancements, and streamlined disclosures so that more companies and more corporate entities are encouraged to issue bonds and have market-ready finance available to them. Secondly, alternative vehicles such as REITs and InvITs are still viewed as niche products 10 years after the first notification was issued by SEBI in 2015. We have critical miles to cover before these instruments become mainstream channels to long-term savings. Measures such as improved investor awareness, expanded product lines, robust data benchmarking, and greater institutional participation are key to unlocking their true potential. Lastly, there is need to give fillip to other pooled vehicles and to municipal bonds, as was mentioned by Chandrajit. These vehicles, maybe specially pooled municipal bonds, can democratize access to capital for small and medium ULBs, which are also the space where India grows, where the hub of economic activity at the medium and small scale remains. The IFSC at the GIFT City is emerging as a global hub for financial services, encompassing stock exchanges, clearing corporations, depositories, and a comprehensive network of market intermediaries. A set of tax and regulatory reforms have been made to make it attractive to international investors, broker-dealers and insurance companies and others. And you'd be happy to know how IFSCA has doubled down on capital market innovation through its enhanced regulatory sandbox regime. Under its updated FinTech sandbox framework, IFSCA now offers a three-pronged structure: a live regulatory sandbox for real customer experimentation, an innovation sandbox where firms can trial products using anonymized data, market data, and an interoperable regulatory sandbox for hybrid business models regulated by multiple authorities. This approach grants firms regulatory relaxations, clear testing horizons, and robust safeguards for investor protection. In line with the push for infrastructure reforms, the government has been moving towards programmatic approach through the development of various pipelines, the National Infrastructure Pipeline, the National Monetization Pipeline, and the setting up of the National Investment and Infrastructure Fund was a unique and strong step taking forward financing in the infrastructure space. Today, NIIF-1, as we call it, has mobilized more than 16,000 crores for investors. And apart from this, there are many ongoing structural and financial reforms, infrastructure financing options, as I mentioned, through REITs and InvITs, creation of the NAPFID, and continuous work to push the ecosystem of the PPPs through MCAs. Over the past few years, government, along with financial sector regulators, has introduced many regulatory reforms to ease compliance. The underlying philosophy, thank you. It's okay. The philosophy behind these fundamental reforms is the desire to ensure that regulatory effectiveness and reforms, responsiveness improve, regulations which are needed remain, become more cost-effective, and are in a simple language and easy to comply. The sense that government has is that the bulk of the corporates want to be in compliance. It is for us to respond to make compliances and regulations easy to comply with and be cost-effective, and that is the path that we are taking. And now it has become a continuous and compulsory exercise throughout government, different ministries and different regulators. The last part of what I would like to say is that while we have come a long way, the financial sector is continuing to evolve, and new trends are emerging which require rethinking existing paradigms. It warrants innovative approach going forward. It warrants, I would say, more collective thinking, more partnerships. Let me point out a few, and I'm sure over the next 2 days, there would be many others which are pointed out for greater work and deeper analysis. The financial sector is undergoing a transformation. On the savings front, there is a rising financialization of savings, a shift from bank deposits to mutual funds and equities. To put this in numbers, in the last 5 years, the mutual fund AUM has more than tripled, with bank deposits having grown by a little over 70%. Within banks, it is the low-cost CASA deposits which are showing a declining trend, reducing the net interest margin for banks. On the credit side, financing from non-bank sources seems to have increased, reflecting higher reliance on market-based funding. The share of banks in total credit is down from 77% in 2011 to close to 60% in financial year 2022. Additionally, equity-based financing has gained immense popularity, with the number of IPOs increasing 6-fold between 2013 and 2024, which is a healthy sign of financial sector deepening. Another trend is the deleveraging of the corporate sector. With the help of NIPFP, DEA has had a preliminary analysis done. While that work is going on, I would share some data. This is a study which NIPFP is doing for us using firm-level balance sheet data. It has been found so far, work in progress, that the internal resources have consistently been becoming the most important funding source, growing significantly from 60% in 2014 to 70% in 2024. At the same time, the share of external resources has steadily declined from about 39% in 2014 to about 29% in 2024. Further, the reliance on institutional debt seems to have fallen. Bank and financial institutional borrowings have come down significantly, and this trend is far more pronounced in the manufacturing sector. An important last point is to re-emphasize how important our financial system is as a strategic driver not only of long-term growth, which it is, but at the same time in also ensuring distributional equity by including the low-income households and MSMEs in the formal financial sector. We recognize that MSMEs face persistent credit constraints, which are compounded by delayed payments from large buyers and limited access to formal debt markets. Towards that end, I believe that we must best utilize our DPI and technology-driven solutions, such as cash flow-based and invoice financing, which can enhance liquidity for this sector. While the public sector would continue to focus on infrastructure development, we hope that the pass-through of the recent GST reforms will ignite the much-needed animal spirits in the financial sector. These emerging trends that I have highlighted call into question the usual known ways of doing business and challenge all of our stakeholders to come up with the most optimal and effective solutions and outcomes. And far from being worried about these trends, take the bull by its horns, work collectively, analyze them deeply, and see how to channelize these so that financial flows become smoother within the domestic economy to all segments that require finance to help us grow in pursuit of the Viksit Bharat of 2047. Thank you so much.